Quantitative Easing for Dummies by Warren Mosler. Fact Box. What is quantitative easing? Quote, New York, Reuters. The Federal Reserve on Tuesday cut its target for overnight interest rates to 0.25%, bringing it closer to unconventional action to lift the economy out of a year-long recession. The message is they're instituting quantitative easing on a fairly large scale, said Doug Roberts, chief investment strategist at channelcapitalresearch.com. Under quantitative easing, central banks flood the banking system with masses of money to promote lending. End quote. Central banks exchange non- or low-interest-bearing assets, reserve balances, for longer-term, higher-yielding securities. Since lending is in no case reserve-constrained, the extra reserves do nothing for lending. The purchase of the longer-dated securities results in lower longer-term rates than otherwise. The lower borrowing rates may or may not alter aggregate demand. The lower rates for savers definitely lowers aggregate demand. Quote, They usually do this when lowering official interest rates no longer is effective because they already are at or near zero. End quote. True. Quote, The central banks add cash by buying up large quantities of securities, government debt, mortgages, commercial loans, even stocks, from banks' balance sheets. End quote. Yes. Quote, Giving them plenty of new money to lend. End quote. No. They already and always have infinite money to lend. Available funds are not a constraint for the banking system. The constraints are regulated asset quality and capital requirements that are expressed in the rates banks charge, not the total quantity of funds available. Quote, It is a tool used by Japan earlier this decade to combat deflation and stimulate the economy. End quote. Didn't work then either. It was fiscal policy that kept them afloat, though not a large enough deficit to sustain output at full employment levels.